Welcome to a special live edition of Who Charted. My name is Manish Khatta, and with me I have Daniel Russo. We took a couple months off. We've been busy doing other things, but we're coming back with a strong first start to 2024 with a live edition. Some housekeeping notes. Both Dan and I are in the Northeast. There is a code blue at schools. They send our kids home. Torrential downpours, 75-mile-per-hour winds. The downside of recording a live show is that may matter here. So we're going to do our best to power through this with our fingers crossed that everything doesn't just go off. So, Dan, how are you, sir?
I was actually spending most of my morning building the Ark, so I'm ready. When time comes, I will abandon the house and start rowing.
Generators have been tested. Yours at least gets started once a week, and I think we're in a good place.
To do that.
All right. Well, let's jump in to the webinar. First thing we're going to cover are major trends in the market. Keep in mind, what we're doing here is covering some of the charts that caught our eye in 2023. None of this is investment advice. It has no bearing on how we manage money. It's simply a conversation and a discussion about things that we find interesting. So, Dan, kick it off with the S&P 500, sir.
S&P 500 weekly chart. The top of the chart should not be confused with resistance, is what I've heard. Simply means that we are at or near all-time highs. And mind you, most of these charts are as of December 31st, so not including the first week pullback that we saw there. But S&P 500 ended the year near the highs on a nominal basis. I've seen some perma bears out there say that it doesn't count because if you adjust for inflation, we're not at new highs. But I don't know, new highs, top of the chart, up and to the right, however you want to define it. I think that that's pretty bullish, especially with a long-term moving average, 60 weeks moving higher also.
I think it's important to note that we have not yet made a new high. Now, there's a lot of camps out there that have different viewpoints on this. I come from the school of thought that it's important to break through that old high before you get too excited. Let's not get caught up in labels about bull and bear or whatnot and what market we're in. But of note, we still have not made an all-time high yet. And so
bull and bear label, is that a new clothing brand? Is that what you're wearing?
We giggled earlier this year if it's going to be the greatest rug pull of all time, where you get close enough to the all-time high to give it a kiss and then fall on your face, but only time will tell.
Would love that.
Moving on, S&P 500 equal weight.
Equal weight closing in on a high, not at a high. I like this one. This is bullish, in my opinion, largely because it flies in the face of the narrative that we heard all throughout 2023, which was the market is unhealthy because it's only being dragged higher by 7 stocks. We'll touch on the Mag 7 later. And that's just patently false. Now, is this a strong secular uptrend? No, but you have the equal weight S&P 500 a lob wedge away from all-time highs above a rising 60-week moving average. Walk me through the weak breath picture. I don't see it. Maybe you do. I don't know.
This is also the consensus darling of 2024. Everyone and their mother is coming out predicting that equal weight will outperform. One thing to note, we test systems all day long, going back over time with our indicators or even combinations of indicators. Equal weight actually outperforms cap weighted over a long period of time.
I think most people don't know that, but yeah, that's 100% true.
It's true. All right, NASDAQ 100.
NASDAQ 100 did trade at a new all-time high in 2023. And what I like about this one is it's obviously bullish. It's above a rising 200-day moving average. But what's interesting to me is people talk about bubbles. People talk about the fact that, again, that leadership is narrow and it's just the NASDAQ or it's just these 5 stocks, 7 stocks. All the NASDAQ 100 did was get back what it lost in 2022. Right? So on a 2-year stacked basis, it's flat. And on a 3-year basis, relative to the S&P, relative versus the S&P 500, this monster that's leading the way and supposedly has us in a bubble, is flat relative to the S&P over 3 years. Now, granted, there's a lot of overlap there, fine, but I don't know. That's not a bubble. To me, if this breaks out, I would say that that's a 2-year base breakout on an absolute basis, a 3-year base breakout on a relative basis, and you probably have some running room.
Sometimes you just got to look at charts and say they are up and going to the right and move on with your day.
That's what I usually bring in my 9-year-old for.
Russell 2000.
I think that this one is rivaling the equal weight for the most consensus bullish call of 2024. I don't think I've had a conversation yet in the past month where somebody hasn't pitched me small caps and said this is the year for small caps. Maybe. You know what? I hope so. It would make things interesting. It would broaden out the rallies from a performance basis, not a participation basis. So I hope that's the case. Right now, as 2023 was coming to a close, you did have a small breakout of a multi-month consolidation. To the extent that that holds, to the extent this is the ETF, IWM, to the extent IWM is above 200, it's probably bullish. And that's probably okay for the overall market from a breadth perspective. So the only thing that scares me here is my 9-year-old pitched me IWM last week. So now what?
I just had a lot of work to do. I mean, you had a 32% drawdown to the June lows. Went nowhere.
16% off the highs or so?
Correct. And we retested those lows in November. And yes, we had a great bounce off it. We're still 16% off all-time highs. So I know it's on everyone's radar. We're getting excited about small caps. It has a lot of work to do. So until it can, solidify and actually break through and hold, still a lot of question
marks. Look, I hope so. Otherwise, I'm going to have to go out and get that tattoo you keep talking about. Just buy the S&P.
It's the new logo here. ACWI XUS.
ACWI XUS. I mean, basically, this is very similar to the small cap trade. I think that this one is neutral at best right now. Listen, nobody wants to see international work more than me. I studied international finance for a little while. I think it's interesting. It's a big world out there. There's so much more to the world than the US, but it hasn't paid to be there. I had a conversation with somebody recently who was telling me you have to have a static allocation to international. And if you showed this chart relative to the S&P, it's done nothing but go down for 15 years. I would argue that you're doing your clients a disservice if you just park any capital in international. The trend is flat on an absolute basis, as we can see here. Choppy 200-day moving average, hard to get excited. The relative trend is actually a complete disaster. I want them to work. I can't get behind it yet.
One of the reasons why we don't believe in blindly buying and holding asset classes. I mean, international, if you look at some of the 10-year stuff, I mean, the returns are putrid, and the drawdowns are even higher than the S&P 500. So where's the value being added? Yeah, I've heard it for years. It's gonna turn.
Where I think you can add value is by not. I think you can add value by not lumping all this stuff together as quote unquote international. Latin America outperformed the U.S. last year. S&P 500 was up, 25%? There were pockets of LATAM that were up low to mid-30s. So if you want to do the extra work, there's opportunity.
For sure. But anyway, 52-week highs right now, still roughly 8% off an all-time high. And
52-week highs, same place it was 10 years ago.
Correct. That's in the disclosure. 10-year yield.
This, I guess, is bullish for yields, bearish for bonds. Bigger picture, I think the story here is we could safely say at this point that the 40-year downtrend in yields is over. I think if you want to argue that at this point, you're, blowing in the wind a little bit. And I think this is interesting because the majority of us in this business, our entire careers were defined by falling rates. For a lot of people, I think this topped on your birthday, right? Like early 1980.
Yeah.
So for most people, the entirety of their lives has seen nothing but rates go down up until the past couple of years. So I think that is going to create an environment that is drastically different from what most of us are used to. And if you're not a student of the markets and a student of market history, you might see some things that surprise you here going forward.
One of the things that's going to be a recurring theme here is, chart lines don't go straight up or straight down. And there's a lot of short-term fluctuations. And what we want to do and what we love to talk about is focusing on what trend changes are there, right? That's why this is in the trend section. We're not worried about what happened over the past couple months. Where is the trend and where is that going? And we'll touch upon that in later on when it comes down to stock-bond correlations.
Yeah, TLT and the drawdown. Just take a look at this. TLT and the drawdown. This is the most mind-blowing chart probably in the deck. Some people have seen it already. We presented this at our conference a few months ago. And the point here again is getting back to what you said about international and how we don't believe in having a static allocation to anything. I mean, TLT for most investors and for a lot of tactical managers, TLT is the go-to quote unquote risk off asset, right? If you're using some sort of timing model and your timing model tells you to get defensive, this is generally where people go. And at one point in 2023, this was sitting at a 47% drawdown from its all-time highs. That is an equity-like drawdown for your quote-unquote defensive asset. I don't get it. It doesn't make sense to me. But what's interesting is notice when the magnitude of the drawdowns changed. Somewhere around 2020, as the trend changed in the 10-year yield. So this is going to be a big deal for people. Not enough people are paying attention to it still. And the simple fact of the matter is your risk-off asset is your risk-off asset until it isn't. And blindly going to somewhere doesn't make any sense to us whatsoever. What was the market down? I mean, these are equity-like drawdowns, 54, 58% drawdown in 2008, 2009, the financial crisis. I mean, this is your risk-off bucket.
This also was one of the asset classes that completely uncovered some of the bullshit that's behind risk profiling software and quote unquote the risk scores that are delivered out there. This is not over. I know some people feel like it's bottomed, it's turned. I think this story has a lot more left in terms of how it's going to play out, not only on the long end of the curve, but also on the short end of the curve. A
lot of people, when I show them the TLT chart, tell me I'm cherry picking. I'm basically going out on the long end of the curve, choosing the most risky of the Treasury assets. I guess I could have gone to the zeros if I really wanted to do that. But I don't know. Here's IEI. This is kind of the middle of the curve, 7 to 10 years. This still gave you a 14% drawdown off the highs. And again, more importantly, look at when the magnitude of the drawdowns changed. I mean, this was hovering, this spent 15 years hovering around a 2 to 4%, maybe a 6% max drawdown. And then all of a sudden you're seeing numbers double that, right? The world has changed. And if you think you're just going to blindly own treasuries, I don't know. Good luck, I guess. More power to you. I'd rather be a little more thoughtful about it.
Credit spreads.
This one's interesting because we constantly are reading that the levels of debt in the economy, whether it's corporate balance sheets, whether it is credit card debt, et cetera, is going to lead to some sort of quote unquote credit event. I don't even know what that means. I don't even know what the definition of that is. Feel free to loop me in. But the simple fact of the matter is the credit market doesn't see your event. These are high yield credit spreads. The difference between high yields and safe, quote unquote, safe treasuries. These are short-term treasuries. And this has done nothing but trend lower for the past 2 years. That is a 52-week moving average that is also moving lower. So I see lower lows and lower highs over the past 2 years. I see a declining 52-week kind of. So let's zoom out and see the long-term trend moving lower also. So if you're going to pitch me credit as the bear case, somebody probably needs to tell credit.
Yeah, I mean the debt superstorm and the credit crisis that's coming. I mean you just don't have to follow headlines. You can just look at this. I mean this has predicted every quote unquote credit issue. Now this can happen all at once, right? You can't get caught off guards.
Yeah, the caveat here is that this does act somewhat like the VIX in that it will be a little bit more coincident. It started to rise 2014 ahead of the kind of the energy debauchery in 2015 with all those, junk credits. But in 2020, you didn't get a heads up. This spiked as the markets were tanking. So it can be a bit of a coincident indicator. But right now it's just trending lower.
Got it. Let's jump to some of the places in the fixed income market that we focus on. High yield bonds.
Yeah. So we focus on high yield bonds. And again, this is up and to the right. So getting back to credit, this is arguably one of the more risky pockets of the fixed income market. And this is a total return basis. We are above a rising 200-day moving average, and we are within striking distance of an all-time high. I mean, this looks very similar to a lot of the equity markets out there. And if you look at high yield bonds, they're highly correlated to equities. But again, I have a hard time with the credit narrative, like the poor credit narrative or the ticking time bomb narrative around credit, when high yield bonds, go out at a 52-week high and, are a stone's throw from all-time highs. Something that we pay attention to is the trend within the riskier pockets of the fixed income market. And as this slide and the next couple slides will show, high yield munis, very similar situation, not quite as bullish, but at the very least, we could say that it has stopped going down. 2022, a large downtrend, 200-day moving average heading lower. Now that 200-day moving average is flat. For the hardcore subjective TA people, you have a potential double bottom there at $23. So you start to get above 25, and this chart acts a lot more bullish as well. So I don't know, high yield munis, high yield bonds. We like to look at emerging market bonds. Very similar situation. At the very least, we could say the downtrend has halted. You've got a 200-day moving average that's flat with a small upside bias. You have price that's trading at or near 52-week highs, if not all-time highs. This one's not near an all-time high, but 52-week highs. So, the riskiest pockets of the fixed income market, or risky pockets of the fixed income market, are trading well. So hard for me to make a bear case around credit, but I'm open to ideas.
We do look at these three areas as proxies, so to speak, bond proxies for the equity market. And so, we're big on intermarket themes, and when junk is confirming and up and to the right, like the stock market is, those aren't bearish things that happen. So you're just looking for those non-confirmations. So let's move on to my favorite part of any chart show, which is breadth.
Market breadth is, yeah, go ahead.
No, started NYSE advanced decline line.
NYSE advanced decline line. Listen, if the equity price trend is strong, you would expect to see a lot of stocks going up, right? And you would expect to see more stocks going up than going down at a minimum. And while this has been choppy and while this trended lower through most of 2022, as you would expect, 43-week moving average through most of 22 was declining. Well, we've seen the opposite kind of take hold here in 2023. That 43-week moving average is now moving higher. The advanced decline line is above it. Are we at all-time highs? No. But does this chart look like the disaster that the breadth bears would have you believe? Not to me, but maybe I'm missing something. It's not as bad as people think. Now, I think the biggest distinction that people need to make in the market as they argue about breadth is the difference between performance and participation, right? The Mag 7 outperformed this year. That simply means that the biggest stocks in the market went up more than the other stocks. That does not mean the other stocks did not go along for the ride, right? There were a lot of stocks going up in 2023. It's just that the biggest stocks went up more. The biggest stocks going up more is performance. I actually wrote a blog post about this. It's on our website. Participation is when a lot of stocks are moving in the same direction as the market, and you can't argue with me that that's not the case. The bear case centers on performance, disguised as breadth. Breadth looks at participation. And
well, I mean, I think there's just a general lack of understanding of what advanced decline is, right? You have one stock that goes up 10% in one day, and another stock that goes up 0.5%. Well, guess what? Two stocks advanced for that day, right?
And some people will tell you that that's the flaw in this indicator, is that it doesn't differentiate for magnitude of moves. But I don't know. It's been around.
I mean, it's not the flaw. It's not a flaw. It's the way it's calculated. It's just, it's understand how these things are calculated, right? It doesn't, and that comes back to your point: participation versus performance. Yes, the Mag 7 crushed everything, but who cares? Everything else still participated and went up, which is why the advanced decline line has not diverged. Because of the fact that you still had participation, which has been missed across the board. Moving on.
And look, if you don't believe in what we have to say, and you're just kind of a boglehead acolyte, then you actually want that to be the case, right? If you're just going to buy the index, then in a cap weighted index, don't you want the biggest stocks to do the best? If you're not going to bother putting any thought into it and you're just going to buy the index and go about your day?
Yeah.
All right, breath thrusts.
Breath thrust, let's go.
I'm getting it right here. It's added right here. Breath thrusts. We look at breath thrusts two ways. We're looking at 5-day ratio of advancers to decliners and a 10-day ratio to advancers and decliners. And generally speaking, if the 5-day ratio gets above 2.5 or the 10-day ratio gets above 2, a much harder feat, that is bullish. Now, in 2023, there were 4 instances where the 5-day ratio got above 2.5, most recently in early November, as the market was coming out of the kind of fall consolidation, correction, label it what you want. 2023 actually started with a very rare 10-day breath thrust above 2. I believe it was mid-January or so.
Yep.
So again, walk me through the bearish breath case when a 5-day ratio of advancers to total issues, this is on the NYSE, can get above 2.5, 4 times in the year. I don't see it. Walk me through it.
Yeah, and look, this is it doesn't mean that the market can't go down or you shouldn't actively trade around other themes. But from a breadth case, which is the title of this section, there's no real bear case to be made right now. Let's move on to some
listen,
volume.
I think that if you're paying close attention and you go through the sections of the slides, what you'll see is each section of the slide deck is basically how we view the market. What are the price trends? Is the price trend healthy? Well, that's breadth. And is the price trend confirmed by other pockets of the market, intermarket analysis? You'll see that later. Another breadth ratio that we like to look at is volume. Obviously, in a bull market, we want to see a lot of stocks going up, and ideally, we want to see more volume trading in the stocks that are going up than the stocks that are going down. And I know you have your caveat on this one, but as a standalone indicator, we had 4 instances in the fourth quarter of 23 where we had quote unquote what are known as 90% up days, where 90% of the volume traded on the NYSE was in stocks that were going up. That's pretty substantial. A lot of people use 80 as the cutoff. I drew the line at 90 just to show that there were 4 in the fourth quarter. If you include 80% up days, we had a lot of healthy days. More so, I mean, some people's counterpoints are, a couple of these 90% days followed 10% days. Okay, sure. But there were a lot more 80 and 90% days throughout 2023 than there were 10% days. So, I mean, just let's take a diffusion of that and say that this was okay.
I mean, so this one bothers me because I feel like this is the one that people have the most fun with numbers on. When I watch posts and write-ups about, volume ratio hitting 90, this is the time to own stocks. Like, these things are great, but they cannot be used in isolation. If you don't believe me, go look at 08 to 09 and let me know how all your volume bursts work. Now, those same people will come back to me. Right? Well, for sure. No, well, they'll come back to me and say, well, 12 months later, right? But we'll save that for a separate webinar. So yes, it's strong, but in isolation, it's quite meaningless in a lot of ways. But absolutely, I mean, it's confirmation of the breadth story. It's confirmation of the different trends that we're talking about. But it's from a trading signal perspective, you got to be a little careful here.
I mean, just lump it all in with what we've discussed so far, strictly from a breadth perspective. You have an advanced decline line that's not falling out of bed. You had multiple breadth thrusts looking at advanced decline data. Then you add in the volume data. And now you add in, this is net new highs on the NYSE. So 52-week highs minus 52-week lows. And what you'll see is that for most of 2023, there's more black on the screen than yellow, meaning we spent more time above the zero line and we closed the year with this metric trending higher. Largely speaking, if a lot of stocks are making 52-week highs and a lot more stocks are making 52-week highs than making 52-week lows, that's probably okay. That's probably a decent environment. If I really wanted to crowd this chart and go back 2 years, what you would see is the complete opposite. You'd see that 2022 spent most of the time below the zero line. And that's what you would expect to see in a bearish environment, in a weaker market. And that's exactly what you saw, right? So on its own, not that interesting. Combined with everything else we've discussed so far, it's hard to make a bear case. And maybe that's what should scare us, right? Is like, I hate saying it's hard to make the bear case.
Yeah, I mean, look, I think some of this is just math, right? You know, every big decline is you have a spike in new lows, right? Mathematically, it makes sense that deeper declines are led by an expansion of new lows, and typically rallies are led by a decline in new lows. And so, while nothing is guaranteed, I think it's important to track this part of the breadth story, which, you know, will coincide with some of the other things we're doing. Keeping on the same theme with breadth, equal weight versus cap weight.
So this gets back to that participation versus performance. And, you know, for the people who are making the case that equal weight, this is the year, right? This is the year for funds like the small caps or the equal weight S&P. I mean, October, November, that was a logical spot to bottom out. But if you're going to kind of say that the bull case for the stock market hinges on equal weight outperforming cap weight, I would urge you to look at 2022, right? You don't even have to go back that far. You just have to go back 2 years and see that during 2022, equal weight outperformed cap weight, and the market was a disaster, right? S&P was down over 20%. The NASDAQ was down, 40% from its high at one point, right? And then in 2023, the market was strong and equal weight lagged cap weight. So, you know, if you want to be a little bit more thoughtful about your allocations, then fine. You want to pay attention to this chart and say, all right, when equal weight is outperforming, maybe I want to look there. Maybe I want to pay attention there. But if you're going to use equal weight versus cap weight to make a market call, you're barking up the wrong tree as far as I'm concerned. But again, this is an example of participation versus performance. And if you're just by the index person, you want to see this line going down. Because,
well, I mean, when we look for confirmations, it doesn't have to actually, in some cases, like equal weight and in small caps, they don't necessarily have to confirm. They just can't totally fall apart, right? Markets can continue in their current direction without equal weight or small caps participating. We've seen that. You would like to see a rising tide. It does add a little bit of credence and some maybe let you sleep at night, but the story doesn't have to be there.
I think it gets to how does the performance shake out, right? If equal weight is underperforming cap weight like it did throughout 2023, but that's a function of the cap weight just going up more than the equal weight, I would argue that that's a healthy environment, right? That's an environment where a lot of stocks are going up, but the biggest stocks are outperforming. That's 2023, right? If you want equal weight to outperform and you think that that's bullish, well, I mean, 2022 proves you wrong.
Got it. So a big part of the way we look at markets are intermarket themes, which is to say, you know, even though this is not a red light, green light kind of company in the sense that, okay, breadth is up, market's going up, everyone should be invested. You know, there's other things that can pull at your strings, and largely that comes down to the way we look at intermarket trends. And, you know, intermarket, for those of you who don't know, is simply measuring the relationship between two different asset classes. You know, how are you going to view the market if certain asset classes are moving in certain directions? And first up for that is Dan's favorite, the Dow Jones Transportation Average.
I mean, it goes back over 100 years and it's still useful, right? So how could it not be your favorite, especially if you're a boomer like Manish? The transports have actually been kind of the thorn in the side of intermarket analysis for the past, I guess, 2.5, 3 years, as this index has gone nowhere, right? Just a choppy sideways trend around a choppy sideways 27-week moving average. The Dow Industrials ticked an all-time high at the end of last year, and this did not. So in theory, for the purists out there, that is a non-confirmation. Now, we use the transports within our composite models. We don't use the Dow theory by its definition, but, you know, a take on Dow theory. And, you know, the fact that the market has been strong, breadth has been okay in the face of this, I think is a testament to the fact that this is a bull market. And I think that if you got this to break to the upside, that would be just kind of an added upside kicker or an added bullish data point to the trends that we're seeing. And I can't believe I'm speaking as bullishly as I am, but it is what it is.
Moving on to Dan's middle name.
Semis, Dan Semis. Listen, this is something that we don't currently use. We have done and continue to do research around the intermarket relationship of semiconductors and semiconductors relative to the broader market. It just kind of makes sense from the standpoint of, if you think of the Dow theory, looking at the industrials and the transports, right? That was created at a time when railroad companies were the internet stocks of their day, right? We live in a little bit more of a digital world now. Semiconductors, semiconductor content is doing nothing but increasing in every aspect of our lives. So we want to pay attention to what semiconductors are doing. They ticked at an all-time high, above a rising 40-week moving average is a weekly chart. So 40 weeks is roughly the 200.
You're just never going to stop trying to add this into the mix. You know, we tested replacing the transports with the semiconductors, and the performance was absolute shit. So,
but that's because you didn't curve fit it properly. So if you just
we don't curve fit around here.
I'll get it there.
All right, moving on. It's not adding it. Go commodities.
Commodities. Obviously, we want to pay attention to what commodities are doing as a kind of a read on the economy, but more importantly, this is another asset class that a lot of people forget about, and for good reason. Over the past 20 years, there hasn't been a lot of reason to think about commodities. But what I think is important is when commodity cycles play out, bullish commodity cycles, when they play out, they don't play out over a year, they don't play out over 6 months. They play out over, think in terms of your time frame being a decade, right? The 1968 to 1980 commodity cycle, 12 years. There was a commodities bull cycle from 1999 to 2008, and if you looked at gold till 2011. My point is, these bullish cycles play out over a long time. Now, we had a bottom in 2020, a rally, and then a pullback, and then to the point that you were making earlier, Manish, nothing goes up and down in a straight line. There's an ebb and a flow to this. But I think that if you're ignoring commodities, you're doing so, at your detriment potentially, because it is an asset class out there. It makes sense to be paying attention, right? It's something that competes for capital. And, we have conflict in the Middle East right now that so far has not spilled over into the energy producing areas of that region. What if that were to happen? Energy is the largest component of this index. You've had a nice run. You had a nice run from 60 to about 140. You're pulling back, perfectly normal. I think that I am in the super cycle camp, and you're probably only about 3 years into it.
Yeah, I mean, ultimately, you need more time to see if this is a long-term change or this was a pandemic blip. And it'll have wide-ranging effects in terms of inflation and the stories that have been so prevalent in the last 2 years. So the point of it is, nothing goes straight up and down, right? And you have to see how these trends play out. And I think it's going to be an important factor in where the world is going in the next couple of years. Another important factor is the dollar.
I mean, the dollar is kind of interesting because there are a lot of people who believe that there is a strong inverse correlation between the dollar and stocks and the dollar and other risk assets. And
they would be wrong.
They would be wrong over a long enough time frame. Now, short-term correlations come and go. And I'll give credit to the fact that in the short term, the past couple of years, that inverse correlation has existed. If you line this chart up with the S&P 500, the inverse correlation is there. If you were to say try to create an indicator out of this, which I've done, it's actually not that compelling. But to the extent that the short-term correlations are in place, a weakening dollar, which is what we saw throughout the fourth quarter of 23, is a tailwind to equities. Now, the caveat here is that could change on a dime because the longer-term correlations just don't hold. I was reading a study where somebody was actually saying the long-term correlation between the dollar and U.S. equities is zero. No correlation at all. Not inverse, not positive, zero. I've tried testing this a few different ways. I find it hard to get excited about anything that I've seen. But listen, the short term is there, and the market is, there's a psychological element to the market. So to the extent that people believe it's true in the short term, it could be somewhat self-fulfilling. But listen, at the end of the day, this hasn't gone anywhere for over a year. It's just kind of chopping sideways. So very similar to stocks, very similar to the NASDAQ, right? It's just gone nowhere. So just a sloppy mess.
I mean, for purposes of interesting charts, it's interesting because there is a short-term correlation. It's not interesting because there's absolutely no long-term correlation, and there's no indicator to be made of this. But we'll see because there's some short-term movements.
An open mind, right?
Does.
You can't just listen. The correlations that were in place 5 years ago don't necessarily have to be in place today. And and I think what you're going to start to see too, especially in the charts coming up, is this concept of that the world is different. The investment world is different relative to what we're used to, right? This is an interesting chart because this is the chart that a lot of people talk to when they want to make the recession call. This is the copper to gold ratio. Copper is an industrial metal widely used throughout the economy. Gold is the safe asset, right? A safe asset. So if copper's outperforming gold, people, and I believe this, people will say that the economy is doing well, right? Walk around your house, and don't do this, but if you did do this, rip your walls down, you're going to see a lot of copper, right? Rip the sheetrock down, you're going to see a lot of copper. And when copper's outperforming, that's generally a good sign. And when copper's underperforming, that's generally a sign of economic slowdown. Now, this has been trending lower for, 2 years. So as an indicator to call a recession, it doesn't appear to be that good. We're in the process of doing a lot of testing with this as an indicator for equities and fixed income. And I guess we'll keep you up to date, so to speak, on how that turns out. But, this is an interesting chart. But again, keeping an open mind is really important because this has been trending lower for 2 years. And I think it's probably been 2 years that people have been saying the recession is any day now. And it just hasn't played out. We have a better chart for you if you want to try to call recessions.
Yeah, and also, I mean, keep in mind that these aren't precise. There's some indicators that are very precise, right? You get in, you have a short amount of time to extract gains. This is not one of them. This is another fun with numbers kind of chart where you're looking at bigger macro themes to determine if you should be worried about anything. Growth versus value.
Growth value debate. This is one people love to have. I think it's kind of interesting. But again, this gets back to performance versus participation. A lot of people saying, well, you need to see growth outperforming for the market to do well. Well, yeah, that's just a large cap bet, right? If you look at the growth indexes, the growth stocks tend to be the same stocks that are the largest stocks in the market, right? Your Facebooks, I'm not going to call it Meta. Your Googles, I'm not going to call it Alphabet. Nvidia, Microsoft, Apple, the group, right? So I think a lot of people like to have this debate. I think it's largely worthless as a signal for the market. I think that if you want to use it, then use it as a way to kind of skirt your tilts, right? Your allocations, right? Use it a little more thoughtfully as opposed to just saying, oh, growth over value, so the market has to go higher. Say, okay, well, if value's outperforming, like maybe you should probably own a little bit more value as opposed to sitting with your static portfolio.
Let me start here real quick. So momentum is obviously it's a theme, or it's a factor. It's a way to look at asset classes, and it's been tested over decades and decades as a very successful factor and a way to look at rotations and getting in and out of different asset classes. Now, it has underperformed for the last 2 years. But 2 years doesn't make a portfolio, and so it's one of the things that are interesting. But I think there's a lot of long-term value in what momentum provides. So anyway, not to lead the witness,
agree with that.
but
And here's what I'm
momentum
going
with
to
market.
say. I'm going to say that as somebody who is an advocate of momentum, as somebody who believes in the momentum factor. I mean, literally, the person who won the Nobel Prize for saying the market is efficient and can't be beat admits that the market can be beat by momentum, right? Gene Fama says that the market can be, they called it the premier anomaly. So if you're not going to pay attention to that, okay, good for you. I'm going to. The simple fact of the matter is this trade got crowded, in my opinion, largely because people like us are very vocal about it, number one. And number two is it's not super difficult for the average person to implement this strategy, right? Take the 11 sectors of the S&P 500, group them by their past X months return, and buy the top three, right? That's a momentum strategy. It became really easy for do-it-yourself investors to kind of put together portfolios, feel like they're doing something, important, and not just buying an index. But here's what I love about the underperformance of the past 2 years. It is this underperformance that makes it so that most of those people, and most professional investors as well, don't stick with it. I was having a conversation with somebody and they were loving it because this is when people drop out. This is when people stop using momentum. This is when the trade becomes less crowded. So you've had this underperformance. This is relative to the S&P. And we want to see a reversal here. But largely speaking, it's proven itself out over time. I do believe it's the premier anomaly. And I want less people doing it. So I am going to say that this is potentially bullish.
Seasonality. I personally love seasonality, but once again, it's not something that you should use in isolation. It really gives you a better understanding of the background that you're in. What market environment are you trading in? Not necessarily buy and sell signals per se, which some people do abuse this concept with. Let's start in with year 3 of the presidential cycle.
Yeah, I put this one in here because it's amazing to me. Flying in the face of everything you just said, if you just followed the presidential cycle year 3, you would have gotten the market exactly right last year. I mean, this is the average going back to 1951 of third years, which is what last year was. And it basically followed perfectly. The S&P 500 almost perfectly followed this pattern where you had a rally to start the year, much to everybody's dismay. Market kind of tops out in the summer, goes sideways. The market was probably a little weaker than this model would have you see, and then rally kind of through the back half of the fourth quarter. And that's exactly what played out. Now, but again, this is not ever the only reason to do something. I consider something like this, it tells you what the environment is. And it's a nice upside kicker when it's
well, let's just full disclosure. I mean, within our indicators, when this fires, actually, its actual indicator, it just makes it harder to give a sell. It doesn't say that you buy on January 1st, although it would have been great. It just makes it harder to give a sell. And that's just background information. What environment are you in? Moving on, year 4 of the presidential cycle, since that's what people care about right now.
Yeah, so we're in an election year, or year 4 of the presidential cycle, and this is what the average has looked like. Now, N equals 19 here, so consider sample size. But largely speaking, you have a choppy market into about mid-March before giving way to an uptrend on average. I think it's about 7.4%, using the mean. Again, so this is the backdrop, right? This is what the average election year looks like going back to 1952. There are 2 massive outliers. If you look at I know you're going there.
Fun with numbers.
2008 was a down 38% year. We all know why. And 2000 was also an election year, and the bursting of the dot-com bubble. So, I mean, those are 2 outliers. So, I mean, they're outliers that actually skew this to the downside. I think that an election year, if you strip those out, right, so fun with numbers, would actually be a lot stronger than this would have you believe. But those outliers happen, so you can't strip them out. I love when people do that.
I mean, two portfolio and retirement and life-changing events out of an N equals 19. Got it. Volatility, let's get right into it. The VIX Index.
All right, this gets to what we were talking about. The VIX Index just trending lower for the past 3 years, trended lower throughout 2023. Low double-digit VIX is a decent environment. Now, I know what most people are going to say. Most people are going to say, well, a low VIX means the VIX is mean reverting. So because the VIX is low, it has to rebound and the market has to sell off. That actually is proven to not be the case. A friend of ours actually wrote an extensive paper on it. Low VIX does not necessarily precede a spike in volatility. The opposite tends to be true. A high VIX does tend to mean revert back down. But this is what you want to see if you're bullish, right? Remember 2017, just a steady grind higher, right? You had a VIX there, below 10 at various points, 0, 3% or 0.5% pullbacks throughout the year. If you're bullish, you want to see the VIX just grinding people out, grinding the bears out. I'm not saying that's what's going to happen. I'm not saying we're going to a single digit VIX, but the VIX is low. That's what you want to see, and it doesn't mean we have to spike.
And I mean, this is once again something that we always talk about here is avoiding headlines, right? I mean, people get all hopped up on volatility at headlines, and I mean, it flows through to the numbers, right? And VIX is one of them. The other one is the MOVE index, which is essentially the VIX on fixed income.
Yeah, so it's the VIX on Treasuries. And this gets back to what we were talking about, right? If you're going to blindly use something as your risk-off asset, and if you're going to continue to do that, even though the price trends have told you that that's dumb, well, then you better be aware of the volatility of the product you're trading. And what you'll notice here is the complete opposite of equity volatility, right? So you have the quote-unquote risky asset, its volatility grinding lower, and you have the risk-off asset, U.S. Treasuries, and its vol moving higher, right? And this has spiked and stayed there. The VIX actually has spiked to levels that we've seen around, credit events or I hate to use that term, but big events, things like long-term capital, things like the global financial crisis, COVID, right, which you can see on this chart. Right? We're above those levels of Treasury volatility. So, I don't know, safe haven asset? Maybe.
Looking at the comments real quick, the VIX report that you're referring to, is that Thrasher's?
Yes.
Okay. Andy Thrasher's.
Readily available. Andrew Thrasher.
VIX Tsunami or something like that.
Yeah,
right.
Tsunami, forecasting a volatility tsunami. It's on the internet. It's a good read, and it's not a heavy lift. So I would urge people to take a look at it.
Got it. All right, what we find interesting, which is a good segue from the MOVE index and the VIX index, because the first chart is something. Yeah, but I think this is something that we have been very vocal about. Not only because it's interesting, but also because it's going to change a lot of what financial advisors do. If it hasn't already, it should. And that is the stock-bond correlation.
Yeah, so this is the big one. Now, we started talking about this in April of 22, so almost 2 years. And not a lot of people were talking about it at the time. There was one or two others who we know who we were kicking these ideas around with. And the simple fact of the matter is, from about 2000 until about 2 years ago, there was an inverse correlation between stocks and bonds. This is the S&P 500 and the 10-year note price. That inverse correlation allows things like the 60-40, 70-30 portfolio to be an absolute rock star for nearly 2 decades because bonds actually did serve their purpose. They served their purpose to provide protection. When stocks went down, the bonds went up. There was this inverse correlation for the most part on both the 1-year and 5-year time frame. Now, we started talking about this 2 years ago. It's nice to see some other people coming around to it now. I recently actually saw Urian Timmer from Fidelity talking about this as well. So, the big guns are starting to get on board. This shift in the correlation. Now, prior to 2000, stock bond correlation was positive. So this is not an anomaly, right? It's just a change of regime. And what's interesting about this chart is we've been watching this chart now for 2 years, and we've been watching that 5-year number on the bottom slowly creep up, slowly creep up, slowly creep up, and then it's like an asymptote at the 0 line. It finally ticked above 0. You have to squint to see it, but that number there says 0.02, meaning the 5-year correlation between the S&P 500 and the 10-year note is now positive to go along with the 1-year correlation. And that, to Manish's point, changes the calculus for people who are structuring portfolios.
It changes everything around how you construct portfolios, right? I mean, we all we do is work with advisors, and if you have a group of people that are passive and have a 60-40, 70-30, 80-20, we're not making a market call here. We're just saying this is an interesting chart for how you're going to view that dynamic going forward, because if those things become even more correlated, your risk management piece is no longer managing risk, and that's something that people need to be aware of when they're constructing portfolios. Once again, I think it's important here to make it, there's a lot of people out there that will trash the 60-40 because of the last couple years. We're not going to be in that camp. It has done well because of the environment that it's in. Change the environment. It's not the fault of the 60-40. It's just the fact that we could be in a new environment.
Yeah, or how about you couple that with the fact that your risk-off asset or your diversifier is now moving in the same direction as your risk-on asset. And now go back to the MOVE chart. It's more volatile. So yeah, the environment's changed and you probably need to be aware of it. And the thing is, all the models that you look at and all the simulations, they got 20 years of data that are going to tell you that the bonds are still the risk-off asset. So you need to be paying attention to this in real time.
Absolutely. Moving on. Inflation.
And this is the driver, right? This is the driver. You went from an inflationary environment until about 1990 to a disinflationary environment. It's very rare that we see deflation, i.e., negative price growth. But a disinflationary environment, that yellow line there. And again, this is something that, for the most part, for most people in this business, for most people paying attention, probably most people who are on this call, that yellow line encompasses your career. Right? It's an environment where, for the majority of your career, or all of it in some of our cases, it's been a disinflationary environment. And now you've had a spike in the CPI. This is the CPI. Sure, 9%. You can talk about COVID. You can talk about supply shocks, et cetera. But the simple fact of the matter is we're now seem to be settling in this 3 to 4% range. That's double the Fed mandate and well above levels that we saw between 2000 and 2020. So why the shift in stock bond correlation? Simple intermarket analysis. Go read John Murphy's book. In a inflationary environment, stocks and bonds tend to move together. In a disinflationary environment, stocks and bonds tend to move inversely to each other, right? No one's a genius for implementing 60-40. You did well because you were a product of a disinflationary environment. If this number is going to hang out between 3 and 4, you got to start viewing the world differently. And I realize that 3 and 4 is not 9. It doesn't have to be. It's not 2.
I'm not going to do it. I'm not going to complain about the $7.99 hot chocolate that I paid the other day because that inflation's not coming back down.
We don't see prices like that in New York City. It's just we're just regular people up here, man. $3.99 for a hot chocolate.
Move to Tulsa.
All right, now everybody wants the Fed to cut rates. Everybody's talking about the Fed is done with its rate hike cycle and the Fed is going to cut and they're going to cut soon. What's interesting is, the first cut is the deepest. I'm riffing off of a song there and kind of showing my 90s age. But anyway, you don't necessarily want the Fed to be cutting rates. If the Fed is cutting rates, remember, the Fed tells you they're data dependent. We all know that, and we all know that they're slow, right? So if the Fed starts cutting rates, things are probably getting bad or already are bad. We're probably already in a recession. And if you look, when they cut rates in 2000 and when they cut rates in 2007, right, that tended to mark the top of the market. Now, it was the rate cut 2018, 2019 was a little bit early before the market sell-off, but fine. The simple fact of the matter is if you look, right, selling the rate cut is actually a better strategy. So if you're out there rooting for rate cuts to bolster your equity market view, you are not a student of history, my friend.
The market rallied because of the expectation of rate cuts, and it's one of those things where you got to be careful what you wish for. And so who knows what the futures are saying about when that first rate cut's going to come. But
the market seems to be pricing in 5 or 6 rate cuts this year, even though the Fed told you it's going to be 3. So that's a whole other expectations game. I always love this conversation, like what's priced in. You don't know what's priced in. Nobody knows what's priced in, right? And if you did know what was priced in, you wouldn't be telling people what's priced in. You would trade it, and then you'd go buy an island and live on it. So I don't know. You can have that debate. To me, it's a dumb one. But if you're rooting for rate cuts, you're rooting for an environment that necessitates a rate cut. So I don't know, be careful.
And talking about environments that necessitate rate cuts.
Here, again, if you want to make the recession call, right? If you're necessitating, or if the Fed's cutting rates, the curves have started to uninvert, right? And it's the uninversion of the yield curves that tend to mark when a recession is beginning, right? The gray lines, the gray shaded areas are recessions in the U.S. If you live in a different country, I apologize. But these are recessions in the U.S. And what you'll see, it's not the inversion of the 210 curve that leads to the recession, but it's actually the uninversion that you should worry about. And at the bottom here, that's just the 9-month trend of the curve. So generally what you see is the 9-month trend turns positive, the curve uninverts, and then you see a recession. That's kind of the way it's played out. 1980 was different, and maybe that'll be different too, because 1980 was the last time we had an inflationary environment and a recession. And the way that the curve steepened, we can get into bull and bear steepeners another time. But for purposes of this call, the 9-month trend has turned positive here. the curve is flattening. It's still inverted. The curve will uninvert in anticipation of those rate cuts. And that's usually a better signal than the copper gold indicator for a recession. And just because this is in the section of what we find interesting, this is the Mag 7. We've talked about it. Mag 7, as you know, Amazon, Apple, right? NVIDIA, I'm probably Microsoft, Tesla, I have it written down, Google. Nice year. Flat on a 2-year basis, both absolute and relative. So don't tell me it's a bubble. Don't tell me that the market is unhealthy. All these things did was get back what they lost in 2022. So we'll see how it plays out. And again, if you're a market index person, you want to see this breakout. Now, this is not exact. This is an equal weight S&P, equal weight Mag 7. I didn't go through and look at all the different weights when I built this. But equal weight Mag 7 is, on the verge of a breakout. And if you're going to get my tattoo, just buy the S&P. You want to see this breakout.
People love looking at how well an investment does in the amount of time it takes the Earth to circle the moon, circle the sun.
If you look out,
neither here or there.
Look out 1 year.
Disclosures. Just read them for a second. Make sure you know what they say. Some definitions, and ending it with a couple things. Number one, thank you for your time. Number two, this is not investment advice. We don't make predictions. We think predictions are complete and utter horseshit. What we do is educate our advisors and on the charts we find interesting and see how they play out. A lot of these things you just don't know in a short-term horizon. You have to let trends play out over a long time. Dan, any closing thoughts?
No, I think that's the case. Pay attention to what the market's telling you. I think more than ever, we're going to be surprised by things that we see. And I think that's largely a function of, the shift in inflation rate. And again, most of us don't know any better. We've only seen an environment where rates have gone down. We've only seen a disinflationary environment in our careers. We've only seen an environment where blindly buying a 60-40 portfolio has paid you well. And a lot of the old relationships, a lot of the old correlations that we got accustomed to could change, right? And being open-minded to that, right? And pay attention to prices more, right? The price trends are, if the market's a discounting mechanism, important things should show up in price before you even know it's important. And I realize that we move in a world now where information travels a lot faster, and you're not on Twitter anymore because you're a Twitter quitter, but the information flow is a lot faster, but it doesn't change the fact that the price is a discounting mechanism, and if it's important, you're going to see it there first. So
got it. And we're bringing back Who Charted so we can get the greatest 5 charts
are we
out the
bringing
door,
Drew
right?
back too, or is
No.
it me and you?
Just me and you. All right, that's it. We survived the storm. Power's up. Thank you, everyone, for joining. Have
Thanks,
a great
everyone.
week. My birthday's tomorrow.
Oh,
I'm
boy.
going to Encanto with my kids, live.
Encanto's good.
Dreams do come true.
Yeah, they do.
See ya.
Thanks, everyone.